When you've been in the market long enough, you see the same patterns kind of re-engage and re-emerge, always with a bit of a different twist. They've always got, their own twist on what's happening today in politics or the market or the world globally, or even at a local level, at the state level, what laws and politics are impacting the market. But they still seem to follow a similar pattern.
You're listening to Property Investor Tales, stories from the front yard.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha Bright and I'm the head of the advising team here at Positive Real Estate, where we help people build wealth through property. With over 10,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier and will inspire you along the way. So today I'm talking through a recent success story for our clients, and we discuss what made this off-the-plan development so good despite some bumps along the way. I trust you'll enjoy it. Hey everybody. As you know, my name's Tabitha Bright. I'm head of the advising coaching team here at Positive Real Estate. And today I wanted to take you through a deal that our clients completed that has seen some fantastic results. But like all deals, it's really easy to look at an end result and go, gosh, I wish I got into that. I wish I'd seen that, or how didn't I know about that? And gosh, it's so good. But we don't see the bumps and the scrapes behind the scenes. And what were the key indicators that made it a good deal that we can keep an eye out for in the future for other types of deals? Because in every market, there are pros and cons, and the markets shift and change. They're cyclical. So when you've been in the market long enough, you see the same patterns kind of re-engage and re-emerge, always with a bit of a different twist. They've always got, their own twist on what's happening today in politics or the market or the world globally, or even at a local level, at the state level, what laws and politics are impacting the market. But they still seem to follow a similar pattern. And at the moment, as we know, the Melbourne market is beginning to see some early signs of growth. It's been a stagnant market really since COVID. And Brisbane went through the same thing, although we often have short memories. And we had a lot of clients getting into the Brisbane market, as early as 2012, because like Melbourne, all the fundamentals were showing us that it was a market that had substantial pressure on it, that was ticking all of the boxes for making investment worthwhile, especially long-term investment. Because remember, folks, when we look at investing, we hear the good stories, we hear the big wins, the people that buy something and then they get it valued, especially for off the plan, and it's gone up sometimes hundreds of thousands of dollars. Yes, it happens. But for many of us, it's not that we've made poor decisions. It's timing in the market. And somehow somebody has taken a punt in the market, or made an educated choice, I should say, in the market, and the market's just been with them and they've had a great result. Other times, what is more the norm is for us as investors, we pay attention to all the fundamentals again, we get into the market, and then the market can be a bit contrary, or it can just take its time, which is normal. And normal can look like 8 to 10 to 15 years for a property to do its thing and double in value. And sometimes it can sit 8 to 10 years and seemingly do bugger all. Often you'll get some rent increases and stuff, but the thing that makes us feel good about our investment, that capital growth that we get addicted to, and which we want as investors, that's what creates wealth for us, can be slow to deliver, and then it'll come in a big chunk. But if you waver in those early years, in that 6 to 8 to 10 years of holding a property, and you get frustrated and you sell, you do yourself a massive disservice, because most of the growth comes at that 10 to 12 to 15 years of holding a property and allowing the market to do the full cycle. So hang in there, folks. But the property I want to show you today is one that our clients needed. They needed to have some steel in their veins because it was halfway through COVID, and the acquisitions team found this, what on the face of it looked like a really good deal, and off the plan. It was short term off the plan. It was going to be 3 months. It was mostly completed, and we were just waiting for the occupation certificates and for everybody to be able to go out and get finance and settle. And it was an off the plan from an overseas developer in a suburb called Chermside in Brisbane. I'm going to take you through the presentation I went through at our recent mentoring workshop because I just thought it was really worthwhile for people to understand this. I want this as a easy story that both people in our mentoring and coaching program can see, but also people outside of that. So if you're not a client of Positive Real Estate and you've happened upon this podcast, welcome. And hopefully this gives you some confidence in some of the coaching and property deals and situations that our clients invest in. And this is one that, truth be told, I'm kicking myself that I didn't go into, but it's that thing where, they say don't trust a skinny cook and all of that. There is so much opportunity when you're here in this environment. You can't buy everything, and it's something that, as coaches, as team of Positive Real Estate, it's it's tough to watch sometimes. So I've got a bit of FOMO, but I'm super pleased for all our clients. So let me start the preso. Now, Chermside, the development was called Sparks, and you'll see here that it was an off-the-plan short term in 2021 that our clients bought it. It was at a phenomenal price point. When we look back at these price points now and what's been happening in the market, it's kind of mind-blowing, right? And I'll talk about that in a minute. But at the time, our clients in 2021, so 4 years ago, were able to purchase a one-bedroom brand new apartment at $360,000. And the two and three bedders were anywhere between that and basically $700K for a three bedder. The things that made the deal great was that if you took how big the apartment was and you divided that by the price, you took the price point, you divided that by the square meterage, then you get a per square meter rate. And these particular units built by this developer were very generous. And so the square meter rate was very low. So what that means for us as investors is that there is good potential upside for capital growth. It was very close to a hospital and medical precinct with Westfield Shopping Centre, literally also like a 900-metre walk. Was short-term initially. And one of the challenges we had with this one was that due to some biffo with council, the settlement of the property got delayed by up to 12 months. So this was incredibly frustrating for clients that thought they were buying a 3 month off the plan, but then, and they were going to have it done and dusted and settled and they could move on. And they ended up staying in this deal for a long period of time, for 12 months, and having to wait until the developer got his ducks in a row and was able to get the occupational certificates. We were estimating, based on the market at the time, a 5% yield. There were 108 units in the development, and Chermside's about 10K from the CBD. And some of the units came with city views, which was pretty cool. This is just to give you some, I guess, so you can see where the development is in relation to the hospital, which is here. This is the Sparks development in this little yellow box there, and Westfield Shopping Centre, like literally just a short dash away, 900 metres, as I said before. So, a phenomenal location. And we all know the old adage, location, location, location. And then we look at this per square metre rate. So at the time, the average per square metre rate would have been around sort of 9,000 to 10,000 per square metre. Trophy property, so those really high-end, usually focused on downsizer market type properties, were around 13,000 to 15,000 per square metre. And our clients were buying a one-bedder at 6,100 per square metre, which is just crazy cheap, a two-bedder at 4,800, and a three-bedder at around 6,700 per square metre. So when you think that the average is 9,000, if you were to do some maths quickly, and I've just probably shot myself in the foot by doing this ad hoc, that if you had a 60 square metre property at 9,000 a square metre, you'd be paying about 540,000 for that. But these guys, because of that low per square metre rate, they were paying 385,000. And so when most of the market for that similar product would be paying 590, it's effectively like getting a massive discount. So this was pretty cool. And when we look at what's happening today in the market with off the plan, with the impact post-COVID of supply of materials, a shortage of trade, a lot of builders that were under pressure and chose to either close or went out of business during COVID. In order to be able to make a profit, the per square metre rate for developers has increased. And we're now at up to 19,000 per square metre in the market. So when the acquisitions team for Positive Real Estate go out, they're looking, one of the key things they're looking at, not the only thing, but one of the key things they're looking at is what can they negotiate with the developer to get an off the plan development down to a square per metre rate that means there's value in it for an investor today. And this has been one of the really tricky things, and why for our clients, they're seeing a lot less off the plan apartments coming through, because for the most part, until a market shift happens, which it will, developers are having to price stuff so high that it doesn't make sense on an investment level. And so a lot of our clients are now looking for other opportunity in the market, which often looks like house and land as an example, because there's still value in that market compared to where developers are at. Now, for some developers, depending on their situation, when they land bank the property they've got, whether they have their own building companies and whether they're self-financed or they have to get finance and all these other factors, there are still some developers out there that are able to deliver products on better pricing, but they're hard to find. And we do have a couple of examples of those coming up, actually. If you are a mentoring client, you will see the property showcase that's coming up on the the 17th of September. And I'd love you to pop along to that. So all that information, you should be getting emails, SMSs, and it's also on the private clients Facebook page as well. So reach out to your coach if you'd like to come along to that and find out more about that. But back to the prezzo. So what was intriguing was that despite the low per square metre rate, this is what some of the valuations look like. And I've just taken a screenshot of some of them that came through. Excuse me. And you can see here, this property here purchased a two-bedder at 490, got a valuation at 450. So $40,000 low. And so when we get low valuations, it's normal to start to question, well, is this a bad deal? Part of what we think often as beginner investors as well, like if we're getting a low val, doesn't warrant more research, 100%. But we have to understand that valuations are often about the bank's risk and about your financials over where the market is at. And I'll show you what happened to this property afterwards, because you see here some more of the two betters that are coming in 20, 35, 10,000, and then a stack of them on the money. Where there's a dash there, we just haven't had the valuation data. Might have been an external broker. But you can see for the most part, most of the valuations are coming on the money, but sometimes it's a specific lender. They may have too much exposure already in Chermside, or they have decided they don't want to do any more investment lending in apartments for the next 6 months. It can be a whole gamut of reasons as to why low vals come in. And so we have to go back to the fundamentals and go, if similar product, good quality product, it wasn't shoddy product, it was really good quality product, our clients got to walk through, because remember, it was nearly completed. They got to walk through, see, touch, feel it. So they knew what they were getting. And it's a genuine discount. Then why would we get low vals? And it just comes down to, like I said, bank's risk, the valuer on the day, and other valuers have preconceived ideas about stuff as well. And we have to remember that valuers are also taking a risk. So when they go out and value something in the market, they're risking their business essentially, because if they get that wrong and the bank forecloses on this person for whatever reason and they can't sell it for what the valuation said it was worth, valuers can be sued by the lenders. So understanding everybody's risk in something like this is really important to making good quality investment decisions. Yeah. So our clients all proceeded. They worked through it. They looked at similar properties in the area with their coach. They went back through what were the fundamentals in the market. Did it make sense? The location, the yield at the time, all of that. And they decided to proceed. And so the one that got the very low val, the 40,000, you can see here, paid the 490 for that. And it, in a very short space of time, in the last 3 years, it is now worth $740,000. So it's had a 250K capital gain uplift in that time. And you can see here that it was listed for rent at $665, which we'll talk about in a second, which is also a phenomenal result from a yield perspective. So, you know, who wouldn't want that result? And then one of the other ones that also got a low val, 492,500. Actually, if I go back, we'll have a look. What was that? 492,500. Oh, no, that didn't get a low val. I beg your pardon. And however, you can see here, it's still gone up about the same rate. Yeah. 257,000 since settling in 2022, which is pretty cool. And then just to give you guys some faith in what we're seeing on RP data, we can see here that there have been some investors. It was not only Positive Real Estate that was in this particular development. You can see sold as recently as April, those similar price points. This is a 2x2x1, and this is a 2x2x2. And you can see this one was at 771 and the other was at 700. So phenomenal results. And you can see what beautiful units they are. They're well laid out, they're generous sizing, great views, and clients and renters absolutely love them. This is just some stats from SQM Research, just showing the uplift on units, which is pretty cool. And coming down into, we're now going to talk about the vacancy rates, because when our clients settled, you can see here it was under 1% as a vacancy rate. And you can see that the vacancy rate has maintained that pressure. It's a highly sought after suburb. with not a lot of stock available. So what that means for us as investors, once again, is pressure on rents. So we can get our rents up, which is fantastic. And this is what the rents look like. So in 2022, a one-bedder settled for, after it settled, rented for $425 per week, and the two-bedders were $520. So it was about a 5.5% yield for our clients, which is pretty phenomenal. And in 2022, that was the Chermside market. I beg your pardon. Sorry, I've confused myself. The Chermside market was renting at $425 to $520, and Sparks was $400 to $460 to $520. So the story here is that because we had 106 units all settling at the same time, not all positive real estate clients, but there is suddenly more stock on the market. And what our clients chose to do was to take a small hit in the market with their rent so that they could then go ahead and maximize getting a tenant in there to have some cash flow coming in, and then adjust the rates, the rent, once that initial short-term oversupply, and I'm talking oversupply on a street, not oversupply in a big market, was absorbed. And then what it looks like now, which I think we're up to, is Chermside is getting $500 per week and $637 per week for a two-bedder. But Sparks is now outperforming the market, once again, because they're a generous size. So they're they're spacious. They are in an awesome location and well laid out. So it's a well thought of floor plan, which also contributes to your capital growth. And so what that means is that the rents are higher in this development than in the rest of the market. So one beds are now getting $550 and two beds are now getting $675 per week compared to $637 of the market. So in summary, low vals when stock is discounted to the market is common, and it doesn't mean that if you are going into a discount deal, that if you get a low val, that it's not a real discount, that it means it's a bad deal. You have to go back to the fundamentals. You have to work to see things for what they are, do your proper research, and then move forward based on what you find out. Don't just assume because you get a low bank val that it means it's a dud deal. Rent fluctuations are normal when volume settles. So our clients definitely went through some hoops when they settled this deal to make $250K plus in 3 years' time. And those bumps and scrapes it took longer to settle than they thought. So they were caught in a 12-month bit of a hamster wheel, wondering when they were going to get to settle. That was frustrating. There were some low vals that came in for some clients that had to navigate that. They had to discount their rent initially to get people in quickly to then put up their rents. And it's important that you know that these problems are normal problems when you're often investing in property. Some deals will just be super straightforward and not cause you to even blink. Other deals will put up roadblocks and annoying challenges like this did. But persevere, my friends, because if it's easy, everyone would do it. And it's normal to get a bit fearful when we get some feedback from the market or from a deal or from a lender or whatever it is. But don't let the seagulls get in the way. Don't get the caw-cawing and throw you off course. Go back to your strategy, why you bought it in the first place, because the fundamentals will drive any short-term correction and get you growth long-term, which is part of why we do what Jason says. And we buy well and we never sell unless we're selling strategically when it comes to our lifestyle phase. That the magic team is in holding property for the long term. So even though these clients have got a great result, we don't flip it and move on. We hold because there is the potential for these properties to double in value. And I know that because I did a similar deal in Sydney. Many of you will have heard Jason, myself, Sam talk about it in Dulwich Hill, where I bought a 2-bedder for around 400,000 that is now worth $1 million, that is sat in the market. It's done its time in the market, and it's a pretty straightforward 2-bedroom. It's nothing fancy, but it was a good location, a good layout, a good size, and ultimately that appeals to the market when you do your time and you let it cook. It's like, the analogy I like to use is it's like baking. You can have all the best ingredients and you throw them in a bowl and you mix it up and you put it in a cake tin, but it's not a cake until it's had time to cook in the oven. And property is exactly like that. You put the best ingredients into the market, you let it bake, and you have your cake, but you don't often get to have your cake and eat it too at the same time as mixing it. We have to give it that time in the market. So I hope that was helpful. I just wanted to bring to your attention an awesome deal that many of our clients had done and done successfully and enjoyed, but they had to see it through the process. So thank you very much for listening. And I'll be back with a new interviewee in the next fortnight with another story to tell. Thanks so much, folks. Bye for now. Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.